Looking for a great deal on a great stock? Like the idea of buying shares after a 25% drop in price? Want a yield that beats the market and dividend growth that beats inflation? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading chemicals company for the production of countless everyday products. Consumption of everyday products is such an integrated part of everyday life that people are often referred to as consumers. Think about that for a second. You're more a consumer than a person. Well, this is not going to change. If anything, consumption is on the rise. And this company makes sure that a variety of everyday products are actually able to be produced. This puts them in a position to grow their revenue, profit, and dividend for as long as consumption is a thing. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Eastman Chemical Company, which appear to be trading at a significant discount today. Eastman Chemical Company, stock ticker EMN, is a global specialty chemical company that manufactures and markets a wide range of advanced materials, chemicals, and fibers which are used in various consumer and industrial products. Founded in 1920, Eastman Chemical is now a $12 billion by market cap chemicals giant that employs 14,000 people. The company reports results through 4 segments: additives and functional products, 35% of fiscal year 2021 sales, advanced materials, 29%, chemical intermediates, 27%, and fibers, 9%. The company generates 42% of its sales from inside the US, while the remaining 58% comes from outside the US. Eastman Chemical has exposure to nearly every industry you could think of, spread out across most major markets in the world. Everyday end products that are used in everyday life often require advanced materials and chemicals in order to be manufactured. Packaging, electronics, autos, and cosmetics are just a few examples. Eastman Chemical is a part of the backbone of the global manufacturing complex. This positioning has led to steady growth across the business, and unless the world suddenly stops consuming manufactured products, Eastman Chemical stands to grow its revenue, profit, and dividend for many years to come. To date, the company has increased its dividend for 12 consecutive years. The 10-year dividend growth rate is 11.1%, but I will caution that the size of dividend increases can be somewhat lumpy from year to year. Plus, the stock offers a market-beating 3.2% yield to start off with. That yield, by the way, is 40 basis points higher than its own 5-year average. With a payout ratio of 31.2% based on midpoint adjusted earnings per share guidance for this fiscal year, this is a healthy dividend poised for much more growth. I really like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. This stock offers both a yield and a dividend growth rate that are on the higher end of what I tend to look for. Very, very sweet. Looking at business growth, Eastman Chemical increased its revenue from $8.1 billion in fiscal year 2012 to $10.5 billion in fiscal year 2021. That's a compound annual growth rate of 2.9%. Not amazing, but certainly not bad either. Meanwhile, earnings per share grew from $2.93 to $6.25 over this period, which is a compound annual growth rate of 8.8%. Modest buybacks have helped to move the needle in terms of excess bottom line growth, and net margin has improved relative to the starting point. Pretty good bottom line growth, but I'll caution again that the growth can come in fits and spurts. earnings. The business is cyclical and the results are lumpy from year to year, but the long-term picture appears to be very good. Looking forward, CFRA believes that Eastman Chemical will compound its earnings per share at an annual rate of 10% over the next 3 years. This would mark some acceleration in growth relative to the last decade. The optimism doesn't seem unfounded to me. Rightfully so, CFRA highlights Eastman Chemical's diversified portfolio as a key strength. In addition, they note that pricing power and cost savings will be two levers for the business to pull. CFRA states, and I quote, "We see more upside in 2022 from strong growth in Eastman Chemical's specialty products and pricing actions," unquote. CFRA then adds, again, and I quote, "We also think Eastman Chemical's focus to remove $200 million of structural costs by 2022 will benefit the firm's earnings profile in the medium term," unquote. I would also point to Eastman Chemical's own fiscal year 2022 guidance for further evidence of a reasonable forecast here. The company is guiding for $9.75 in adjusted earnings per share at the midpoint for this fiscal year, which would represent 10.2% year-over-year growth compared to the $8.85 in adjusted earnings per share the company reported for fiscal year 2021. This kind of earnings per share growth would support similar dividend growth over the foreseeable future, and pairing high single-digit dividend growth with a 3.2% yield is quite enticing in my view. Moving over to the balance sheet, the company does have a good financial position. The long-term debt-to-equity ratio is 0.8, while the interest coverage ratio is 9. Eastman Chemical's balance sheet isn't spectacular, but there are no financial issues here. Profitability is solid. Over the last 5 years, the firm has average annual net margin of 9.2% and annual return on equity is 16.1%. Eastman Chemical doesn't necessarily wow me in any one area, but it's just a well put together business that looks really good on a sum of the parts basis. And with economies of scale, IP, R&D, and technological know-how, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Raw material and other input costs can be volatile, which causes fluctuations in cash flow. The cyclical nature of manufacturing exposes the company to slowdowns and recessions. There's technological risk, as manufacturing technologies could change in a way that would reduce the need for some of the company's offerings. Overall, I see the risks as very tolerable, especially when viewed against the quality and growth profile of the business. And with the stock down 25% from its 52-week high, the valuation makes it especially compelling at this point in time. The stock is trading hands for a price-earnings ratio of 10.7. That's about half that of the broader market's earnings multiple. It's also materially lower than the stock's own 5-year average PE ratio of 17.3. We can also see that the current price-to-sales ratio of 1.2 is slightly lower than its own 5-year average of 1.3, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That dividend growth rate is not as high as I'll go, but I think it builds in a margin of safety. This mark is lower than the company's demonstrated dividend growth rate and earnings per share growth rate over the last decade, and it's also lower than the near-term expectation for earnings per share growth. Also, the payout ratio is still quite moderate. Because of the cyclical nature of the business and the lack of extreme high quality, I find it prudent to be conservative here. That said, it wouldn't surprise me at all to see Eastman Chemical exceed the 7% dividend growth rate over the foreseeable future, but I would rather err on the side of caution. The dividend discount model analysis gives me a fair value of $108.43. The reason I use a dividend discount model analysis is because the business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Eastman Chemical as a 5-star stock with a fair value estimate of $140. CFRA rates Eastman Chemical as a 4-star buy with a 12-month target price of $125. I came out low here, but we're all in general agreement that the pricing is favorable. Averaging the three numbers out gives us a final valuation of $124.48, which would indicate the stock is possibly 27% undervalued. Here's the bottom line, guys. Eastman Chemical Company is an under-the-radar business that is being run in a very competent manner across its operations. Unless global consumption of everyday products suddenly ceases to exist, this company has a bright future. With a market-beating yield, double-digit long-term dividend growth, a moderate payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 27% undervalued, long-term dividend growth investors ought to seriously consider this name while it appears to be on sale. And now for a special news announcement. PepsiCo Inc., stock ticker PEP, is making moves. The company recently announced that they had signed a long-term distribution agreement for an investment of $550 million in Celsius Holdings Inc. PepsiCo is clearly not resting on its laurels, and I love it. We recently covered PepsiCo as a high-quality dividend growth stock that could potentially be recession-proof. Don't sleep on PepsiCo, particularly if you are concerned about the odds of a recession. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.